Hello, my name is Greg Michaelowski, and this is a Forex commentary for FXStreet.com, brought to you by FXDD. This Tuesday, November 16, 2010. I'm back from a trip to the Middle East and also some a little bit of time off, and good to be back. Good to be back giving our commentary for FX Street. But what we've seen here over the last few days, and in fact today, is a renewed interest in the U.S. dollar. We've seen the things like the euro versus U.S. dollar come down to new lows going back to the month of September. We've also seen the sterling and the dollar yen move in the direction of favoring the U.S. dollar. Dollar Swiss as well is also had 8 straight days to the upside. So I thought I'd take a look at each of these currency pairs and go through the key technical levels from my perspective, looking at moving averages, looking at Fibonacci retracements, and looking at key trend lines. The first pair I want to take a look at is the euro versus U.S. dollar, and this pair has been in a nice trend to the upside up until November 4th, when the market had its low on August 24th, and then really started to take off from September 10th to the upside. This all ended again on November 4th when the market peaked at the 142. 1, 2, 3, 4, 5, 6 out of 8 days to the downside. I'll zoom in here. Each of the two up days have been very minor indeed. So lots of pressure to the downside. Now, if I zoom out again, what I'm going to show here is the movement below the 38.2% retracement of the move to the upside here. This is the first significant corrective move, the first time the market has been able to break the 38.2% retracement since the market started to rally on going back to August, or actually September 10th, when the market started its move from that base here at the 100-day moving average. Coincidentally, not coincidentally, that's where the market tends to like. Now, the market moved through the 38.2% retracement, closed below that yesterday, and was able to hold that level here today, and fail at the move above that level as forced the market back down toward the 33. The low for the day came at 134.58. It's not over yet. We may have some room to the downside that may test that 50% retracement. If it gets through there, we'll be looking for the 61.8% retracement in the 100-day moving average. That 100-day moving average comes in at 132.35 level, right near where the 61.8% retracement is. I can't rule these things out, because if you zoom out here and you take a look at the longer term perspective, this all started at 118.76. So going down toward this level would not be out of the question. In fact, if I move the Fibonacci down to the low here, the 50% retracement level comes 38.2% comes in at 133.62, and so all these levels become targets on the downside and would not be out of the question for the market to reach to that level. Let's take a look at the hourly chart. And the hourly chart, we have a nice little channel here, don't we? If you can connect the tops here, connect this top from the November 5th high to the high that we saw here on November 15th. We have other couple times when the market tested that level here today, and each of the time the market pushed against it. Why? Because there's a low risk opportunity here. Selling against a borderline level like this opens up the door for low risk, a potential high reward, and if you're lucky, you get a move like we saw here today. The next level of support off of this channel would come down toward the 133.51 level. Again, that's levels that correspond with things like the 38.2% retracement of this move up from the 2010 low of 118.76. So certainly not out of the question, and a target level that we could see in the near term. Taking a look at the 5-minute chart. The 5-minute chart, I have the Fibonacci level to show you some risk for the day, where I would consider the risk on the upside here, and that is if the market were to get above the 38.2% retracement of this last trend move to the downside. Needless to say, this move is not going to last forever. We're going to probably see some consolidation, and could see a corrective move up to the 135.28 level, but I would expect that we should see some sellers against that level, and it's more likely that we probably have a non-trending type period here, allow our moving averages to catch up, as we've had a nice move to the downside here that took the price from a high of 136.41 down to a low of 134.58, but the bias still remains to the downside for the euro versus US dollar. Let's take a look at the sterling versus US dollar. And off a daily chart here, this goes back to the low of September 7th of this year up to the high. We broke through the 38.2% retracement, and we also broke through this trend line here today. This trend line had a number of little lows here and tested a low a couple days ago. And today, when we broke through that level, it was pretty much on the races to the downside here. When we broke through the 159.13 level, we took another little move to the downside here for the sterling versus US dollar off the hourly chart. We also broke through some key trend lines here. This trend line is of this triangle here at the top that connected the lows going back to November 9th, November 10th, November 12th, and today we came down to that level, moved back up, test the 100-hour moving average. Another good selling opportunity here for those people live trading accounts. Sell against the 100-hour moving average. Your risk is that much, and your potential reward is a break through the trend line and a move sharply lower, and that's what we saw here in the sterling versus US dollar. And I have this line coming across around the 63-ish type area in the sterling versus US dollar, and that corresponds to these highs right here. So we are back down through those levels, and it looks like the market has a further move to the downside, or potential move to the downside. Next stop, 158 level in that currency pair. The dollar versus yen. Taking a look at the taking a look at the daily chart here in this pair. This is the September 15th Bank of Japan intervention, where the market went from 82.87 up to 85.87 here in one single day. That's three big figures to the upside. We're finally above that level after spending all this time below the level. A very narrow trading range. We're breaking through the trend line upside here, and now we have sights of the 100-day moving average coming into play at 84.47. We're still 100 or so, 90 pips away from that level, but there is a lot of room in the upside for the dollar versus yen as it's moved from a high of 94.97 all the way down to a low of 80 here. That's good 15 or so percent move to the downside from the May to November here. Certainly a 38.2% retracement is in the cards, or at least a test of the 84.50, the 100-hour moving average at the 84.47 is in order. That would be the 100-day, not 100-hour moving average. On the downside, where is the risk? The risk comes in if the market should move below the 100 bar moving average on the 5-minute chart. That level currently comes in at the 83.26 level and moving higher. I would also consider this level, this old high for the day, as a level of resistance or support and a level of risk. Why? Because it was the initial high for the day, and then when we broke through the level, what did we do? We came down, tested that level before moving higher. So that somewhere around the 83.32 level, and this 100-bar moving average is also moving up toward that level. Finally, the dollar versus Swiss franc. I mentioned we had 1, 2, 3, 4, 5, 6, 7, 8 straight days to the upside, all green here. It's pushed the market through the 38.2% retracement of just this baby move here. That 38.2 comes in at 99.07. I'm currently trading at 99.68. The next level is par 45, and the 100-day moving average comes in at 101.17. We've been below that 100-day moving average since 109.46, and the dollar versus Swiss has had a high of about 117 all the way down to the 94 level. That's 21 big figures. Let's call it about 19 or so percent move to the downside. Does it have room since the month of May? Does it have room for upside? Sure it does. If I were to move this Fibonacci level all the way up to this high that occurred back on the first day of June, that 117.29 level, 38.2% retracement comes in at 103. What is it? 38 there, and that certainly is would just be a normal correction for the dollar versus Swiss. So the upside looks favored. The only problem is we do have 8 straight days in a row, and we're also running against trend line resistance here off the hourly chart. You can see a number of different lines off the bottom trend line. Put a parallel trend line across the tops that connect this high to this high right here. Oops, I just moved that along. Right there, and we are just above that trend line and coming down to test it again. So a failure up here would likely lead to some corrective moves overnight or as we head into the close, and then a break to the upside. So there you have it, a quick look at all of the major currency pairs. This is Greg Michalowski with a Forex commentary for FX Street.